have thought a Trump tax policy aimed at punishing foreign countries could end up taking money straight out of Aussie investors' pockets. Whether you're investing US shares directly, through ETFs, or gaining exposure via your superannuation, you are right in the firing line. As you may have heard, Trump's One Big Beautiful Bill, the Republican budget, passed through the House of Representatives in the United States. While the bill's physical implications have grabbed most of the headlines, buried deep in this big fat document, on page 959 is Section 899, titled Enforcement of Remedies Against Unfair Foreign Taxes. This would allow the US to impose up to a 50% tax on certain US-sourced income received by applicable persons from discriminatory foreign countries. Yep, I know there's a lot of jargon being thrown around. I'm going to break it all down with a clear focus on what it means for Australian investors. The proposed Section 899 defines a discriminatory foreign country as any foreign country which has one or more unfair foreign taxes. An unfair foreign tax includes an under-taxed profits rule, UTPR, digital services tax, diverted profits tax, and any other tax that is seen by the US government as unfairly targeting US companies. Australia does have 10% GST on digital services, like your Netflix or YouTube Premium subscription. Good thing is it's specifically excluded from being considered an unfair foreign tax under the proposed legislation, so it's not classified as a digital services tax by US standards. However, Australia does have a diverted profits tax and has adopted the OECD's global minimum tax rules under Pillar 2. Both are designed to prevent multinationals, many of them American, from shifting profits to low-tax countries. Because of these measures, Australia could be classified as a discriminatory foreign country under the proposed US tax rules. And we are not alone. Almost every OECD and European countries have implemented similar tax policies and could also be hit by the same penalty tax under Section 899. Now the next question is, who in Australia would actually be affected? The short answer is almost everyone. To understand that, we need to look at the definition of applicable persons under Section 899, and it's surprisingly broad. It includes the Australian government, any individual who is a tax resident of Australia, foreign corporations based in Australia, trusts, superannuation funds, and other Australian entities investing in US assets. When it comes to the type of US-sourced income that will be hit with higher tax rates, that fall into 5 main categories. Business income from the US, investment income from the US, like dividends and interest, branch profits, this refers to the profits of a foreign business operating in the US, capital gains from selling US real estate, income received from foreign private foundations. Here is the current statutory tax rate, the default rate set by US law. However, they can often be reduced under a tax treaty between the US and another country. For example, the statutory US withholding tax on dividends paid to foreign investors is 30%. But thanks to the US-Australia tax treaty, Australian residents typically enjoy a reduced rate of 15%. This is a category that's likely to impact almost every Australian investor, so that's where I will focus. Let's take a look at how the withholding tax rate on US-sourced dividends could increase under Section 899. The starting point is a 15% reduced rate under the US-Australia tax treaty. The withholding tax increases by 5% each year for as long as Australia is designated a discriminatory foreign country. However, the cap on increase is set in such a way that the withholding tax rate cannot exceed 50%. That is 20% above the 30% statutory rate. In Australia, when an individual invests directly in US shares, they typically complete a WA-BAN form, which ensures the US applies the reduced 15% withholding tax under the US-Australia tax treaty. Let's say John buys a US stock that pays him $100 in dividends. Before John receives the money, the IRS, which is basically America's version of the ATO, takes $15 as withholding tax. So John ends up with $85 in his account. At tax time, John reports the gross dividend, the amount before US tax, which is $100, as his taxable income, specifically under the foreign income category on his Australian tax return. Now, let's assume John's marginal tax rate is 47%, including the medical levy. That means he owes $47 in tax on that $100 dividend. But because $15 has already been withheld by the US, John can claim that amount as a foreign income tax offset. So he only needs to pay the remaining $32 to the ATO. Right now, most Aussies investing US shares directly are likely to have a marginal tax rate above 15%, so their overall tax liability remains the same. The US withholding tax and the foreign income tax offset effectively cancel each other out. Between the Australian and US governments, it's basically a coordinated split in tax revenue. The US takes 15% first, and Australia takes whatever is left. That is, the investor's marginal tax rate minus 15%. However, with the proposed increase in US withholding tax under Section 899, both Australian investors and Australian government could lose out. Under the tax offset ordering rules, the foreign income tax offset is applied after all other non-refundable tax and non-transferable offsets. Once your tax payable has been reduced to zero, any unused foreign income tax offset is not refunded to you and can't be carried forward to later income years. There is also a foreign income tax offset limit, which is set up in a way that if your marginal tax rate is lower than the US withholding tax, some or all of the foreign income tax offset is wasted. If the increased US withholding tax is still lower than your marginal tax rate, your total tax bill still doesn't change, as shown in John's example earlier. It just means the Australian government has less left to collect, because the US takes a bigger slice upfront through withholding tax. In a worst-case scenario where the US withholding tax climbs to 50%, every Australian investor would be left with unused foreign income tax offsets. This tax leakage eats into your investment returns, creating what's known as a tax drag. The lower your marginal tax rate, the bigger the tax drag, because a larger portion of the US tax can't be claimed back. And over time, that loss compounds, meaning your long-term net returns could take a serious hit. From the Australian government's perspective, there is no longer any opportunity to collect tax on US dividends. The US takes it all. Even if you don't invest in US shares directly, chances are your superannuation fund does it for you. Exposure to US equities is a key part of most diversified investment options, making this issue relevant for nearly every Australian with a super account. Superannuation operates in a low-tax environment. Investment earnings are taxed at just 15% in accumulation accounts and transition to retirement pensions, and 0% in account-based pensions. If the fund managers of your chosen investment options invest in US shares on your behalf, they still face the US withholding tax on dividends. But because the super fund's tax rate is so low, a large portion of that US tax can't be offset. And remember, the lower the tax rate, the bigger the tax drag, and that drag directly reduces the net returns of those investment options. Another issue worth exploring is whether the Australian domiciled ETFs and US domiciled ETFs that invest in US shares are impacted differently by Section 899. And if so, how that difference plays out for Australian investors. Let's keep it simple. If you invest in a US domiciled ETF like VOO, you, the investor, are considered the direct recipient of the dividends. That means the increased US withholding tax applies to you directly before the dividend reaches your account. You then include the gross dividend in your Australian tax return and claim the foreign income tax offset subject to the usual limits. Now compare that to an Australian domiciled ETF like IVV. In this case, it's a fund manager who holds underlying US shares and receives the dividends. Under Section 899, more US tax is taken out before dividends reach the fund. That means the fund manager receives less after-tax income to distribute to Australian investors. But here's the key part. The fund passes the foreign income and tax withheld to you, the end investor. You will receive a larger foreign income tax offset via your annual AMAA tax statement. You still then report the foreign income in your tax return and claim the offset. But foreign income tax offset can only reduce your Australian tax on foreign income to zero, and any excess is wasted just like with a US domiciled ETF. So the economic impact of Section 899 applies to both structures: higher US tax, potential foreign income tax offset waste, and lower net return. The real difference is administrative. For US domiciled ETF, you do more yourself, fill in extra forms, track USD income, and manage exchange rates. For Australian domiciled ETF, the fund handles the heavy lifting and provides a tax statement tailored for Australian tax returns. Now you know what Section 899 could mean for Australian investors. How should you use this information? First, don't panic. It's important to remember this bill isn't law yet. It has passed the US House of Representatives, but still needs to pass the Senate, where Republicans hold a narrow majority. If it does pass, the earliest it could take effect is 1st of January 2026. However, there is division within the Republican Party, with some senators voicing concerns about the potential economic and diplomatic fallout. That means the bill is likely to face significant debate and negotiation before any final decision is made. So don't make any drastic moves yet. There's still plenty of water to pass under the bridge. Second, take this as informed analysis and personal opinion. This video is based on my own research and interpretation of the proposed legislation. Given the shifty nature of US politics and deliberately vague language in parts of the bill, some details may change or be subject to interpretation. Third, stay aware of the potential trends. As more news and debates unfold, we could see increased market volatility and possibly some degree of US equity sell-off. Investor behavior may start to shift. Some might adjust their asset allocation away from high dividend US stocks, while others may reconsider their product selection, favoring Australian domiciled ETFs over US domiciled options. There might also be a growing preference for US growth stocks or companies that prefer share buybacks instead of paying dividends, since capital gains aren't subject to US withholding tax for foreign investors. Pay attention to which way the wind is blowing. That's likely what the pros are watching. The key is to stay informed and stay flexible. What do you think about Section 899 of Trump's One Big Beautiful Bill? Do you reckon it will actually get passed? Or is it just another Trump headline that never makes it into law? Let me know in the comments below. Thanks for watching. I'll see you in the next one.